I'm Alan Kenny, Editorial Director for REIT.com, and we're in New York at REITWeek 2015, NAREIT's Investor Forum. Joining me is John Bejjani, Analyst with Green Street Advisors.
So, John, we're about 6 years into the upcycle right now in the commercial real estate market. Interest rates, though, still very, very low. Where do you think we are in terms of valuations right now?
Yeah, that's a good question, Alan, and one that we get often, the one that's tough to answer in the absolute. So there are two sides to the real estate valuation coin. The first, cash flow or operating income growth, is pretty healthy across most property types, as accelerating job growth, modest improvements in GDP growth, and limited new supply are benefiting real estate fundamentals for most property sectors. The other side of the coin, cap rates, is clearly tied to the direction and magnitude of movements in interest rates. Now, predicting these movements is a bit of a fool's errand. At Green Street Advisors, we prefer to take a relative valuation approach. Specifically, we look at how investors' return expectations on real estate compare to those of other asset classes, most importantly, fixed income. So on that basis, real estate looks modestly expensive relative to investment-grade bond yields, but cheap relative to high-yield bonds. So overall, we'd argue that real estate is roughly fairly valued today.
And does this hold across all property types, or are there any outliers?
It varies. So apartments and malls are relatively cheap in the private market. Industrial and strip centers are modestly expensive, while office appears to be the most expensive property type currently.
Okay, so it's interesting that office is the most expensive. What does that mean in terms of relative valuations?
In Green Street's view, office properties tend to appear pricey in the private market because investors tend to underestimate the capex needs of this property type, even more so than they do for other property sectors. Public investors partially correct for this issue by tending to price the office REITs at discounts to their underlying private market real estate value. However, they don't go far enough. And this contributes to Green Street's view that office REITs, from a long-term sector allocation perspective, should be an underweight. That said, even though the sector appears pricey in the aggregate, rigorous bottoms-up research can still uncover relative value.
All right, thank you so much for your time, John.
Great, thanks for having me.
And for more on this and other REIT news and analysis, be sure to visit REIT.com.